Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The Sell America trade was back in full force across U.S. financial markets on Tuesday. President Trump's demand for U.S. control over Greenland seemed to stoke anxiety about potential worst-case scenarios. Now, that would include a rupture in the NATO alliance, or perhaps a full-blown trade war between the U.S. and Europe. At the same time, markets were rattled by a sell-off in Japanese bonds. During the Tokyo session on Tuesday, long-term JGB yields spiked on concern over Japan's fiscal sustainability. Let's take a closer look now at the impact of these forces on markets in the Asia-Pacific. I'm joined by Bloomberg's Paul Dobson. Paul is executive editor for Markets in Asia, and he joins from our studios in Singapore. Thank you so much for making time. Help me understand what's going on in Japan first before we get into some of the things related to the Sell America trade and what Trump has had to say in terms of Greenland.
Yeah, hi there, Doug. So much to unpack. But I think for Japanese government bonds, there's sort of a long-term story and then a more near-term story. The long-term story, if we go back over the last 2 decades, Japan has had incredibly low government bond yields for most of that time. No inflation, interest rates rooted to the floor, yield curve control from the central bank preventing yields from rising as well. And we're coming out of that era. Finally, Japan has inflation back. Central bank has started to raise interest rates. And as a result, bond yields have been rising. But actually, bond yields have been rising increasingly and more aggressively, particularly at the back end of the yield curve. So for those 20, 30, 40-year bonds, not just because the central bank is raising interest rates, but also because of those inflation fears. But there's a second story to it as well, which is that Japan has an incredibly large debt pile. And although its debt to GDP ratio has been falling in recent years, it's still way bigger than most other countries. Investors are concerned about that. They're worried about government spending plans. And so right now, we're coming into a potential snap election, and not only the ruling party at the moment and Takaichi, the current leader, wants to reduce taxes on food, which would be a large extra cost for the budget. But the opposition has similar plans. So it seems that whoever were to win this election, there would be these plans which are kind of like unfunded spending. And that reminds us a little bit of when we had the Liz Truss moment in the UK, where UK gilt yields jumped because people were worried that the government was planning to spend without really thinking about how it was going to raise that money. So what we had yesterday was a sort of boiling over of all of those tensions and risks and caution and wariness, which led to a really big sell-off, particularly in the longer-term bonds, 25 basis point jump in yields, which is a very rare event and a very worrying one as well.
You mentioned the Liz Truss moment for the UK bond market. I think that's an apt analogy for what's been happening right now in the Japanese bond market. We caught up with Japanese Finance Minister Satsuki Katayama on the sidelines of the World Economic Forum in Davos, and she told us she essentially asked market participants to calm down. But Paul, I'm wondering about the extent to which this move up in JGB yields has threatened to unravel the so-called carry trade, which is to say that people have been borrowing at the low rates in Japan and then buying global assets. Is this movement in Japanese yields threatening to unravel the carry trade?
It's definitely something that people have been talking about a fair amount. I think let's just go back to Katayama for 1 second, because I do feel that the market may take some comfort from what she said. She was, talking about the need to calm down, that the government's paying attention. There are measures as well that the Japanese authorities can do, including the Bank of Japan doing more buying operations if yields do really get out of control here. But I think that, yes, the rest of the world is paying attention to this because of the fact that for so long, Japanese interest rates were so low that people from Japan were putting their money into investments all around the rest of the world to earn a higher rate of return on their assets. And the risk is that as they get the opportunity to make that same amount of interest by leaving things at home, that they lose interest in sending money out to the rest of the world. And so, as you said, that sort of global carry trade starts to unravel. I think, one thing to consider is that the rise in yields is really for those very long-term government bonds, which isn't typically the sort of area where carry trading activity takes place. And if you look at the very short-term interest rates, the borrowing costs there are still very low, even though the Bank of Japan is raising rates slowly. So the evidence that we've seen over the last few months is that the Japanese have still been prepared to put their money into overseas assets all around the world for chasing that sort of carry return. And that's why the yen has continued to weaken and is still hovering around the 160 level to the dollar at the moment. So at some point that will reverse if interest rates continue to rise. And we will get moments like this where we have a little bit of a fractious kind of blow up and worry about it. But it feels like, until those Japanese retail investors are convinced that they really just want to leave their money at home in a bank account where they can earn interest, then the carry trade will continue to sort of flow cash through the global economy.
So I'm glad that you brought up the BOJ, because we have a policy decision at the end of the week. Now, given the turbulence that we have been describing right now, it probably only reinforces the notion that the BOJ is not going to take any action this month. I mean, in addition to kind of dealing with the inflation story in Japan, there's been so much turbulence. Maybe the BOJ would just like, in the words of Katayama, for things to kind of calm down a bit.
Yeah, they've got a difficult task here, because one thing they could do is raise interest rates sooner in order to show that they're mindful of inflation and want to get that under control and to help the back end of the yield curve. But if they raise rates too aggressively, that risks causing its own problems as well, of course. So the market will be very attuned to what sort of a tone they take, how many rate hikes they're likely to sort of telegraph. We heard from, I think it was Citigroup this week, talking about the idea they could do 3 hikes this year because they need to support the yen. And so, those are the kind of considerations that the BOJ has to keep under control. Domestically, people don't really like higher interest rates, particularly but they also don't like high inflation all that much. So there's one sort of like domestic crowd that needs to be won over. And then in the global markets, if they do hike too aggressively, then that really does put that carry trade dynamic we've just been talking about into play.
So I mentioned the Sell America trade that was back in full force, tied to President Trump's demand for U.S. control over Greenland. We heard today at Davos, Switzerland, from Canadian Prime Minister Mark Carney, and he was saying recent events have shown the rules-based international order is effectively dead. He did not mention President Trump by name. I guess the implication was there. How is this being taken right now? Everything that we're dealing with the Trump administration, the Greenland stuff, the stuff with Venezuela, how is this being read right now across the Asia Pacific?
Yeah, so definitely that Carney speech caught a lot of attention. That was all over the social media when I arrived at the office this morning. I think people taking that as a real wake-up call. And I think that, if you look at global holdings of US Treasuries over the long term, it has been coming down in most nations. Japan might be one exception, but most of Asia has been reducing their treasury holdings, putting more money into gold, looking for, the fact that there are more viable alternatives at this moment in time, higher yields on European government bonds and, notwithstanding the current sell-off, higher yields on Japanese government bonds as well. And so that diversification trade has been a long-term trend, but it does have extra urgency at the moment because of the dynamics that we're seeing from the US government. And I think, it's that sort of sense of mistrust of, the control, checks and controls that there are in the US economy at the moment. The idea that the president wants to control the Fed and have them keep interest rates lower in order to juice the US economy is one thing that investors in US government bonds don't like. US spending plans they don't like very much. US inflation they don't like very much. And the tariffs and just generally, the unilateral controls is sort of turning long-term investors attention to think about alternatives to the US. So I don't think it were necessarily in a full-on, kind of like sell America dynamic so much as US can continue to underperform the rest of the world, because even a small amount of money taken out of US assets and put into, say, emerging markets or into Asian assets or even into Europe can have a much bigger difference in terms of the returns that people are getting as the indexes gain.
So if we're talking about repatriation, I'm curious about the weakness that we're seeing right now in Japanese equities. You and I are talking now, and I'm seeing the Nikkei down by more than 1%. What is this a reflection of in terms of the sentiment right now in Japan, do you think?
So Japanese equities have been on, a really massive tear for the last couple of years. And particularly the tech names within that have been supporting the move higher. So the fact that they're suffering a little bit under the current volatility wouldn't necessarily be too much of a surprise. The equities are very much tied to the yen as well. That's quite an important barometer. A cheaper yen tends to boost Japanese stocks up because it helps exporters. So when the yen strengthens, it causes the equity market to have a little bit of a setback as well. And I think then, we have this element, this dimension of the Takaichi trade, as people are calling it, where, yes, she wants to increase spending, which the government bond market obviously doesn't like. That's what we've been talking about. But equities markets will like that if it helps the economy to grow and and it helps companies to increase their bottom line and to improve profitability as well. So for the stock market, there's a few, kind of different competing dynamics right now in this particularly tense situation.
No doubt about that. Paul, thank you so much for being with us. That is Bloomberg's Paul Dobson. He is executive editor for Asia Markets, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The worldwide sell-off on Tuesday sent the S&P 500 down by 2%. Sentiment cratered when President Trump threatened tariffs on various European countries before some high-level meetings in Davos, Switzerland, on the sidelines of the World Economic Forum. And that's where we started our conversation with Christopher Smart, managing partner at Arbroath Group. Chris spoke with Bloomberg TV host Shery and Avril Hong.
Chris, always good to have you with us, especially on a day like today where we're seeing a lot of excitement, anxiety over the markets, perhaps a global economy as well. Why all of a sudden? So far, when it came to geopolitical friction, investors seem to brush it off, and even the global economy is standing quite strong.
Well, good to be with you both. I think it is a busy news cycle, obviously, and there are a lot of moving parts that I think investors are trying to track and then help price into what's going on. And I think you're probably seeing a reaction to both that as well as, what we've all seen and worried about as, slightly rich valuations. And so there has been a time and a moment for some of this adjustment. To be honest, I'm not sure that this sell-off, even if it continues for a few days, is the big story. I think we're going into what is likely to be a fairly optimistic earnings season. We're moving into a U.S. economy that's likely to grow maybe 2.5% this year, maybe a little more. The IMF has just upgraded global growth projections for this year, and you've got inflation coming down as well as a lot of tax benefits flowing through to the U.S. consumer. So I'm not sure this sell-off is as big a story as the underlying geopolitical tensions that you're asking about. And to me, what the big news is around Greenland is that the president has essentially said he doesn't trust NATO to defend the United States anymore. And that is something that is even bigger than he has been talking about in terms of Europeans need to spend more money or we need to settle something between the Russians and the Ukrainians. This is really fundamentally saying that the U.S. doesn't really trust its allies. And however it works out a deal around access to Greenland, that I think is the underlying rift that investors are going to have to start pricing in over a longer term. What is going to happen to investment flows back and forth across the Atlantic? What is going to happen to trade flows? And in a crisis, who is going to be there to backstop markets if you can't really count on the U.S. to do that?
You actually see this going past 3 years of the remaining Trump administration because you're talking about a fundamental shift in the way that America views its allies in Europe.
Well, it's not so much how America views allies in Europe anymore as much as how Europeans view America. I don't think it's going to be difficult. I don't think it's going to be easy for any president after President Trump to come back to Europeans and say, no, trust us, we're with you, because they know we've elected a candidate like this twice, and they're not going to be sure who's going to follow. And they're going to see that this alliance, this relationship that's built up and been quite successful for 75 years, we have to remember, is facing some real trust issues that, Europeans are going to wonder, are the Americans going to be there to defend us? Europe's adversaries are going to look and say, well, maybe we don't really have to worry about Europe and the U.S. standing together anymore because there's daylight between them and we can separate them. Again, not just on military issues, although those are the important fundamental ones, but on issues of trade, for example. If we're trying to present a common front to China on its trade surplus, that's going to be a much harder negotiation than it was even a week or two ago.
Christopher, you were formerly a special assistant at the NEC in the Obama administration, I believe. Talk to us about how much more difficult this all perhaps makes telegraphing or projecting what Trump's plan is for the NEC, given how the uncertainty over policy has evolved.
Well, I think, this is a very different White House from the Obama White House or any previous White House in the sense of how advisors influence the president, how he makes his decisions, how the different interests of different parts of the government are brought to bear for a decision at the presidential level. I think what you're seeing right now, as your reporter mentioned earlier, the president is going off ahead on this with his opening outrageous bid with the Europeans, and it's up to his advisors right now to try and dial back some of the emotion in the room without contradicting him. But the one decision maker who makes any difference at all in this White House is the president himself, and it's not really clear how much his advisors can help shape what is going to be the final deal that he's ready to accept with regard to Greenland. He may not know himself what that looks like until he sees what room for maneuver he has, what the market reaction is, whether he thinks the U.S. economy can withstand that market reaction, and where the conversation heads.
Christopher, just quickly, if we can, on the market reaction, do you perhaps see a chance that, given how yields have trended higher, that affects borrowing costs in a year where affordability is such a big issue of midterm elections?
I think so, but I think, again, the borrowing costs that you're seeing today are going to turn back to the fundamentals in the economy. And as inflation comes down and we expect Fed to cut rates at least a little bit more, maybe not as much as the president wants, but a little bit more, I think those will come back into realignment. I think the issue with these geopolitical tensions we're talking about is they build up over time and start amping up the risk premium over a series of months and years rather than weeks and days.
That was Christopher Smart, managing partner at the Arbroath Group, speaking with Bloomberg TV host Shery and Avril Hong here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.